as we move to the first topic of our session of the day today, investing the Templeton way in a post-COVID world. To begin with, I would like to first invite the moderator for this session, Mr. Sunil Singhania, who is the CFA charter holder and the founder of Abacus Asset Manager LLP. A brief background of Mr. Singhania. He's the founder of Abacus Asset Management, an India-focused asset manager he established in 2018. Earlier, he was leading the entire investment strategy at Reliance Capital Group across asset management, insurance, and offshore and AIF assets. Mr. Singhania has been the first individual from India to be elected on the board of governors of CFA Institute and currently serves as a chair of the investment committee and a member of the nominating committee as well. He also sat on the CFA Institute's Standards of Practice Council for 6 years and was the founder of our CFA India Society, where he served as a president for 8 years. Mr. Singhania is a commerce graduate from Bombay University, and he's an All India ranker in Chartered Accountancy from ICAI. Mr. Singhania, the floor is yours.
Thanks a lot, Shamit, and it's always a pleasure to be, a part of the wonderful investment conference which we have been seeing over the last 12 years at the CFA India Society. And the society has obviously grown. Rajendra did mention about how the growth has happened, and it's always great to start the session, with a topic where all of us investment professionals have sort of learned and grown from, which is investing the Templeton way. And predominantly and very importantly, how it's changed in a post-COVID world. And, we thank Lauren Templeton, who's here, who's taken the time and who will obviously enlighten us about this interesting topic. Before we hand over to Lauren, a small intro. Lauren is the founder and president of Templeton and Phillips Capital Management, a value investing boutique located in Chattanooga, Tennessee. Ms. Templeton currently serves on the board of directors at Fairfax Financial Holdings, the board of directors at Fairfax India Holdings, and the board of directors at Canadian Solar. Ms. Templeton is the great niece of the great Sir John M. Templeton and serves on the board of trustees of the John Templeton Foundation. She is also a trustee, a current member of the Templeton World Charities Foundation and a trustee of Templeton Religion Trust. She is a co-author of Investing the Templeton Way, the market-beating strategies of value investing's legendary bargain hunter. She received a BA in economics from the University of South. We are so thankful to have you, Lauren. Floor is all yours.
Yes. Sorry. Thank you for having me today. I am excited to join you to give this presentation called Investing the Templeton Way in a Post-COVID World. So like Sunil said, my name is Lauren Templeton. I'm an investment manager. I have been investing for quite a long time. I started investing as a child under the guidance of my father. And then later in life, I worked with my great uncle, Sir John Templeton, and have spent the majority of my career studying his investment philanthropy and the way he applied his investment philosophy. Sorry, it's early in the morning here, and I haven't had my second cup of coffee. But studying his investment philosophy and paying close attention to how he applied that investment philosophy, as well as the historical context in which he made his investment decisions. My book, Investing the Templeton Way, really dives into the historical context so that investors and readers can understand what was going on in the world when he made the decisions that he made and how that influenced him. So I think that's important. I like to start all of my presentations with some of his better known quotes to sort of set the mood for investing the Templeton way. The first is, an investor who has all the answers doesn't even understand the questions. I love this quote because it speaks to his intellectual humility, which I think was a tenet to his investment philosophy. We've all seen occasions, including now, where hubris in the market does not lead to good results. If you're not humble when it comes to investing, you soon will be, is what I can say. The market has a great way of teaching you humility. A major cause of higher prices is higher prices. But when the trend is reversed, then lower prices lead to still lower prices. To buy when others are despondently selling and to sell when others are avidly buying requires the greatest fortitude and pays the greatest ultimate rewards. And this is something that I'm hoping to convince you all of in this presentation, that market sell-offs, panics, crisis events are golden opportunities for you to put capital to work. It's very hard to do. Humans are not we're not wired to be great investors. It does require the greatest fortitude, but it also pays the greatest reward. If you want better performance in the crowd, you must do things differently from the crowd. I mean, that's such a common sense statement, but I would ask you to reflect on that. So if you really want to outperform the index, you have to do just something different than the index. If you want to outperform your peers, you have to do something differently from your peers. And it's very hard, as we all know, you're all professional investors, I would assume. It's very hard to go against the crowd, but you can train yourself to do that. I would argue that in today's market, it is very important to put on your contrarian hat and be able to go against the crowd. And this is my favorite quote and probably his most well-known, but bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. So I'm sure later in the presentation, we're going to talk about the market in India and whether this is euphoric, is it an optimistic market? It's probably not the time of maximum pessimism, but I'd like to address that topic later in the presentation. And then people are always asking me where the outlook is good. That's the wrong question. The right question is, where is the outlook most miserable? Now, we're constantly asking ourselves that question here in my office, and that we can apply that question to companies, industries, countries. As you know, these events can happen in all of the above. And we did find quite a bit of miserable outlook in India during the COVID-19 pandemic. A lot of that, you can talk about the uneven distribution of vaccines or the fact that India has such a large population. It's just simply hard to vaccinate that many people. But when COVID was spreading through India, I certainly think, not a lot of people wanted to invest in India at that moment. We found it a very attractive entry point. So what does investing the Templeton Way look like? Our process is always focused on value. It's led by quantitative reasoning. When we think we've uncovered a statistical bargain, we then turn to valuation and fundamental analysis. At our firm, we believe that contrarian views are rational outcomes. And, our most successful investments over my entire career have been the investments that we have made when a stock or a whole market is temporarily out of favor. And it sounds like common sense, but this is something Uncle John would say. He would say the only way a stock can become a bargain is due to a lack of buyers. So, common sense, but it's hard sometimes to apply that common sense. I keep a sign on my desk somewhere. Let's see, I'll show it to you. This says, "Trouble is opportunity." It is our mantra here at the business. So trouble is opportunity. And in our experience, the best bargains appear during moments of duress and maximum pessimism. And as I stated before, these moments can occur in a company, a country, a sector. So we're always looking for these opportunities. Now, the golden opportunity is when the entire market goes on sale. And during these times, even high quality growth firms can be purchased at a bargain. And I'm happy to review some of those purchases that we have made over the history of our company. But we often look as the golden opportunity is a huge market sell-off. Search for bargains. You should try to buy that particular investment relation to your estimate of its true value. That's certainly something we do. We're estimating intrinsic value. We're often using a discounted cash flow model to estimate intrinsic value. Obviously, that's very industry specific. There are times where we will use a different type of model, a dividend discount model. We'll even look at relative valuation. But somewhere we're making an estimate of what the intrinsic value is of a company. And then we're trying to buy those shares at a 50% discount to our approximation of intrinsic value. So we want that margin of safety. We want to buy the shares at a discount, and we would like a high quality firm. So often that's hard to get, a high quality firm trading at a discount, which is why our strategy is so heavily reliant on taking advantage of moments of maximum pessimism. We don't do a lot of trading on a daily basis. Our portfolio doesn't turn over often. But during these bouts of pessimism or sell-offs in the market, we will be quite active. We certainly have our eye on the markets today. Over the past few days and weeks in the U.S. markets, we've seen a good sell-off. And yesterday, the NASDAQ was down 2% and then closed up on the day. So there's a lot of volatility, and we'll be looking to take advantage of that to pick off bargains here and there. So the last is never adopt permanently any type of asset or selection method. Try to stay flexible, open-minded, and skeptical. Long-term top results are achieved only by changing from popular to unpopular, the types of securities you favor. And just to emphasize this, so, we've heard a lot over the years, value's dead, you need to invest in growth, value's outdated, value's constantly underperforming growth. And I would argue it depends. I mean, are we talking about a low PE strategy? Or are we talking about buying companies that have a high free cash flow yield? There are a variety of metrics you can look at to determine value. And one of the thoughts that I will leave you with is that, Sir John was constantly adapting the metrics he used to the market. So for instance, if you look at his investments in Japan, and that would be in the 1950s, personal investments in Japan, but later for his clients in the 1960s, he was actually taking advantage of accounting nuances and applied a sum of the parts valuation method. So that's the method that he had chosen that he was very focused on then. But then when you look at his large investment in the US at the bottom of the bear market in the early 1980s, about the same time that the media had declared the death of equities in the United States. That's always a good sign, by the way. If the financial press comes out and talks about the death of equities, I think you should take that as a cue to go buy some securities. It's typically a really good sign. But when you look at that moment in the 1980s, he was applying a discount to replacement value approach that, of course, gauges for the effects of runaway inflation. We had an inflationary time period in the early 80s in the United States. So now that inflation is back in the picture, this is something for analysts to remember, that perhaps they should also focus on applying a discount to replacement value. When I worked for Sir John, we were focused on PE to growth metrics, or what we call the PEG ratio, and PEs that were calculated on a 10-year earnings projection. And just to give you some idea of what Sir John saw as a value, he wanted to pay 2 times or less for EPS 10 years in the future. And I do think the shifting of metrics that you focus on really goes back to his intellectual humility that I referenced at the beginning of the presentation, and his intense curiosity. He was very adept at finding the flaw in the consensus thinking and then developing or applying the analytical tools to exploit that flaw. You know, oftentimes we have a tendency to overcomplicate investing and finance, I would say. And anytime Sir John's type of investment, when you hear a strategy that you're just like, oh my gosh, why didn't I think of that? That makes so much sense to me. That is the type of strategy he invested in. So he does have a playbook, and it is a playbook that we often pull out in bear markets. Many of his strategies are detailed in the book, Investing the Templeton Way. One strategy that I'm thinking of in particular is buying closed-end funds that don't use leverage at a 30% discount to NAV during a market sell-off. That way you kind of get the double whammy when the markets rebound. That is a very Templetonian strategy. Another very effective strategy that he ran in the dot-com crisis, or the dot-com bubble in the late 90s, early 2000s, was his IPO lockup strategy. We have that strategy detailed in the book, Investing the Templeton Way. That might be something that would work well now, because there has been just a tremendous amount of insider selling. And I don't think that initial public offerings are a fertile hunting ground for value investors. Typically, insiders know when their shares are highly valued, when they'll get their the most bang for their buck, so to say, by going to the market, tapping the market. So that can be through an IPO, shelf filing, secondary, whatever. Insiders know this information. There's been a tremendous amount of insider selling. But his IPO lockup strategy was that he was tracking the IPO lockup expiration dates. So those are the dates when the insiders can finally sell their shares. And he would short securities about a week prior to IPO lockup expiration, and he would cover about a week later. And he was tremendously successful with that strategy. And of course, there are many easy resources for tracking these IPO lockup expiration dates if you want to do that. I will say the street has certainly gotten very savvy to that strategy, and these lockup expiration dates seem to be staggered. So it's not like every insider is going to come on a certain date and sell. These dates are staggered so that not too many shares hit the market all at once. But that's just something to consider. So in our office on a daily basis, the screens are certainly up. We're looking at them certainly on a weekly basis, and we're using really basic valuation screens that are available to any investor in the world. And we want to run those screens on the largest universe of securities we can find. As Sir John said, why not have the largest universe available? so many people thought of Sir John Templeton as a macro investor. And that's simply because he would come out in Forbes or he would come on Wall Street Week with Louis Rukeyser, and he would make these very broad market calls. But he was bottoms up all the way. And the numbers were telling him where to move capital around the world. So if he found that there were a lot of stocks over in Japan that were cheap, you may hear him talk about his investments in Japan, and it give you the impression that he was very macro. But he was a very bottoms up investor. So we use some of the metrics that are on your screen. These are very common valuation metrics. We rank securities based on those metrics. We're typically looking at the bottom decile in a pricey market. We might be looking at the bottom quartile after we rank these securities. And then typically what you see is the same securities show up over and over. Something new may hit the screen that piques your interest. And that's when we might decide to do additional analysis. So we'll try to estimate intrinsic value for that business. We do stay away from sectors or investments where there's a binary outcome. It's very hard to model something, run a discounted cash flow model on something in the biotech industry, so to say. So there are some industries that we stay away from, but by and large, we're using discounted cash flow models, dividend discount models, and estimating 5 and 10-year PEs to try to determine if the company is trading at a reasonable valuation, if we can purchase the securities at a discount. And then lastly, after we've done that, and we've followed up with some fundamental analysis, maybe some discussions with the company's competitors, try to understand the industry landscape a little more, we will look to apply the purchase decision, which is a combination of quantitative and qualitative rationale. So firstly, Sir John thought about when is the best time to sell a security. And he always said the best time to sell a security is when you find something that is 50% better. So do you have any available cash in the portfolio? Can you find something that is a better bargain? We also maintain a wish list of securities in our office. You'll often hear me talk about this during presentations. I think it's very simple, but it's very important and could be a great tool for you to use in your toolbox. So wish list securities is basically quality businesses that we would like to own that are not attractively priced. The reason why it's important is more from a psychological standpoint. When markets sell off, even the most seasoned investors often get comfortable and they will find excuses not to invest. They will rationalize all these fears and comments out of the media and delay investing. A wish list of securities allows you to pick up your wish list and go to work. And when this happens, your focus shifts, the energy in the office shifts, and it's very empowering. So instead of dwelling on the capital you've lost in your portfolio, you're instead focused on the great opportunities that you have to compound your money at a higher rate of return than the next guy. We have two different types of securities in our portfolio, compounders versus tactical discounts. So a compounder is going to stay in our portfolio for a long time. These are quality businesses that typically we're having to pick up during these moments of maximum pessimism because they do not go on sale very often. And then a tactical discount is something that is going to close quite quickly. So for instance, in the book, Investing the Templeton Way, we talked about how Sir John Templeton stepped in post 9/11 to purchase airline stocks. So he knew when the markets opened up that the airline stocks would crash and he had standing orders put in. That's a very tactical trade. Another example of that would be our investment in Mexican airport operators post the swine flu crisis. So when we're applying tactical discounts, we often do that with a basket of securities. Sir John went in after 9/11, he purchased a basket of airline stocks. We went in the swine flu crisis, we purchased a basket of Mexican airport operators. So we believe to investors, there are only 3 sources of alpha available. So you can have better information, which got very difficult to apply post regulation full disclosure, and can be illegal. So you want to avoid any type of insider trading. But there are managers using this strategy today. Some of the most interesting managers are trying to get an edge, and some really savvy ways. They're going in and scraping websites and trying to get better data before the quarterly earnings come out, and trying to game it that way. That's not really the area that we plan, although we like to have quality information. The second is you can have a better process, and really quant managers fall into this category. Can you build a bit better, faster algorithm to game the market? Or the most simple, and I would say consistent way, is to have better behavior. And this is really where our company plays in this space. We think that we've trained ourselves to have better behavior. And value investing is very compatible with that because it's a discipline. You all know, as value investors, it's a pretty rigid discipline, and that often keeps you on track, or as I tell people, saves you from yourself. I often need to be saved from myself. So Homoeconomicus, I don't know if you guys are familiar with this phrase. I would assume as CFA charter holders that this was somewhere in the curriculum, although the curriculum has changed a lot over the years. I'll have to ask Sunil if this is still a part of the CFA curriculum. But Homo economicus is simply a term that academics use to describe man as a perfectly rational wealth maximizer. Now, that is such an absurd term, perfectly rational wealth maximizer. I could ask you all to raise your hands, but I can't see you. So I'm just going to pretend that you also agree with me, and that you think that humans are not perfectly rational wealth maximizers. I think there's plenty of evidence to suggest that humans are very irrational, predictably irrational, and that our irrationality often shows itself when it comes to money, specifically investing. People are constantly making irrational decisions. So despite the fact that Homo economicus does not exist, and because academics often have to hold things constant when they're developing these theories, it's like ceteris paribus when in economics. Okay, when all things else remain the same, that doesn't happen in the real world. And in the real world, Homo economicus as it also doesn't exist. However, he is the basis for all the theories that are really taught in business schools around the world. So whether you're talking about arbitrage pricing theory, capital asset pricing model, etc., they all depend on the existence of Homo economicus. However, this is a chart from Dalbar. It's produced every year. They have a better chart, but I couldn't put my hands on it for this presentation for some reason. Maybe they haven't updated it for COVID. But this just shows the average equity fund investor versus the S&P 500. Their returns are in blue over a short-term to a long-term time period. And what you should take away from this slide is simply, whether you're talking about the short or the long term, the average equity fund investor underperforms the index. And then the slide that I prefer from Dalbar shows the same data over versus every single asset class. And so what you should know is that the average investor underperforms all asset classes across all time periods. So people are really lousy at this. They make very bad decisions. And how could this possibly be? Well, people are constantly buying when the market is high in value. when your hairdresser is giving you stock tips, probably not the best sign in the world that you should be putting capital at work. But people have a tendency to do that. I often use a slide in these presentations that shows the performance of Warren Buffett, Peter Lynch, and John Templeton. And these are all phenomenal investors that have incredible track records over very long periods of time. And I always note that Peter Lynch once did an analysis of what the average investor had returned in his fund. And when Peter was compounding in the high 20s, like 28%, you can argue with the numbers a little bit based on, what do you count as the start date? But when he was compounding the high rate of return, he did this analysis and he found that the average investor in his funds actually lost money. Some made less than 5%, but they were not achieving the high returns that Peter Lynch was putting out. So that is because investors are constantly doing the wrong thing. And I always warn my investors, I say, look, this is a partnership, the two of us together. I can do a really good job and put up some good numbers, but if you are working against me and you only give me capital when the market goes up, and then you take capital away from me when the market goes down, you know what? Together, we're going to have some really bad returns. So it's important to remember that you can hire the best manager in the world, but if you can't control your own behavior as an investor, you may not have good returns. So it's very important to incorporate this better behavior into your investment strategy, whether you're a professional investor or not. Of course, there's another way to look at this. You could easily outperform these investment legends like Warren Buffett, John Templeton, and Peter Lynch. How could you easily outperform them? Well, you would just add capital to their products when it fell in value. So arithmetically, you would have a higher return. And that's something to remember. Investing can be as complicated as you want it to be or as simple as you want it to be. There's something there for everyone. Crisis events, pandemics, bear markets, as you know, are a staple to the market. Evidence suggests we spend 1/3 of our life in a bear market. And so you should prepare for them in advance. These are your golden opportunities to compound capital at a higher rate of return than the next guy. And it's all about your perspective, right? Research shows that stock prices are 14 times more volatile than their underlying fundamentals. So this is either 14 times more the Maalox you're gonna eat on an annual basis, or 14 times more the opportunities that you have to compound your money at a higher rate of return. I'm thinking specifically of the 1987 stock crash, which is not even listed on here, I've noticed. But that occurred, I believe, on October 19th in 1987, and the stock market was down like 27-28% in a day. And Uncle John was well known for saying that this is going to make our returns for years to come. And you know what? He was right. And that has been my experience too, managing institutional capital, that these are golden moments to distinguish your returns from years to come. So what does this mean today for you as an investor in a post-COVID world? What's going on in the markets, and how should you think about the markets? Well, you know, I personally find this market very analogous to the dot-com bubble of the late 90s. I'm sure you've heard that before. I graduated from college in 1998. So, you know, that memory is definitely fresh for me, except for I think this one is even worse. I mean, we've had, you know, monetary and fiscal stimulus. It's just really incredible the amount of leverage in the system. So I think this could be even worse than the dot-com bubble. Now, should you be afraid of the markets? No, I don't think there's any way to time the markets. Markets can often stay irrational for a lot longer than the average person expects. And Sir John thought a long time and a great deal about when is the best time to invest. And his advice was you should invest when you have the capital. Now, why did he think that? I think he thought that people would rationalize spending. Okay, so if you just keep the money in the bank account, you'll probably rationalize some expenditure. And that there is no way to time it. Things can stay irrational for a very long time. So you should invest when you have the capital. The market's already changed since I made this slide a few weeks ago. But one thing that I think you should keep your eye on in the US and the market in India, which I think, India's had some amazing performance, a top performer in the Asia Pacific region in 2021, certainly. But just like in the US, it's a bifurcated market. Not all securities have participated equally in the rebound off the lows from the pandemic. In the US, actually, as of 2 days ago, we have about 680 companies trading at a price to sales ratio of over 20 times. So, the market has already corrected a good bit. And, 2 weeks ago, we had 759 companies. So why does this matter to you? I want you to think about how absurd it is to pay 20 times sales. I mean, you're all analysts. I know you know this information, but I often reflect on a quote from Scott McNealy, who was from Sun Microsystems, and he gave an interview to Bloomberg Magazine in 2002, reflecting on his company's valuation in the dot-com bubble. And this is what he said, and I think it's important for all of us to remember. I love this quote. At 10 times revenue, so we're talking about there are 680 something companies trading at over 20 times sales, but here he's talking about 10 times revenue, okay? At 10 times revenue, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes I have zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that assumes you pay no taxes on your dividends, which is illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 10 times revenue? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What in the world were you thinking? So I think that is just kind of sums it up. Now, we do see this overextended market, in my opinion. I do think India is pricey. I do think US markets are pricey. I do think there's a bubble in bond markets in the US. There's no doubt in my mind that these things exist. But again, the rebound off the lows of the pandemic, it has not been an even rebound. Not all stocks have participated in the same way. So in India specifically, there are some industrials and financials that might be considered a bargain. Same in the US. So you just need to be really selective right now. So why do you need to be selective today, and does valuation still matter? I'm hoping to convince you that valuation always matters. It always matters what you pay for an asset, okay? And we'll look at a case study, which is Microsoft from 1999, to sort of hammer this or drive this home. So Microsoft is truly and has been a dot-com success story coming out of the late 1990s, revolutionizing technology, and has been a smashing success. It was first introduced in 1985, but Microsoft has maintained its desktop software prowess ever since, with a formidable 77% market share. From a 1990s tech bull's perspective, Microsoft has truly been living the dream. The company still dominates the market it created decades ago, as evidenced by over 1 billion users. Far from a one-trick pony, in the last 20 years, Microsoft has successfully tackled the gaming market, not to mention fought off Google during its transition into cloud-based desktop with Office 365. Microsoft has had incredible success. Now, despite its fundamental success, you should note that investors that bought shares of Microsoft at the height of the dot-com bubble in 1999 had to wait 17 years for a return. 17 years. It always matters what you pay for an asset. So, despite its myriad of successes, investors waited 17 years. And in hindsight, it's pretty easy to see that back in 1998, Microsoft's price to sales ratio of 21.9 times and its PE of 61 times had already accounted for almost 2 decades of success that would follow. So in 2022, counting no less than 680 stocks in the US, and I'm not sure how many are trading in India markets with those price to sales ratios. I think a good many, but I would be interested to learn from some of your panelists if you could do a quick screen and tell me how many stocks in India are trading at a price to sales ratio over 20 times. It would be really interesting later in the presentation. But what are the chances that any of those 680 companies are going to be at least as successful as Microsoft? I mean, they're not high, maybe 1, 2, but there are 680 companies trading at a price to sales ratio at over 20 times. So it's really a good thing to remember. Of course, managing a long short fund like we do, we look at those companies as potential short candidates. And that has worked really, really well for us this year. So that really concludes my presentation. I will leave you with this last slide, which always makes me so happy to see. It's Sir John, and he's reading the Wall Street Journal at the North Pole. I like this picture so much because, one, he was always curious. He was an explorer at heart. I mean, that's really what we are as investors, right? We're all explorers. Investing is our way we do it. It's our mechanism to learn more about the world, people, cultures, politics. That's how I view my job anyway. I am an explorer, and investing is just the way I get there. But here he is reading the Wall Street Journal at the North Pole. I also like this picture because one time I was with him and I asked him, what is it like to manage money in the Bahamas? You're not in New York, you're not in London, you're not in this major financial hub. What is it like? And he paused and he said, I have actually looked at my numbers and they improved when I moved to the Bahamas. My performance got better. And I said, well, why do you think that is? And he said, I think it's because I read the Wall Street Journal a few days later than everyone else. So I think that's critical because he wasn't reading information and reacting to it. So many investors these days, they're watching the financial media, they're reading, they're reacting. If you're reacting as an investor, that is not a healthy place to be, I would say. That's not a rational state of mind, right? It's better to read information late, think about it, absorb it. You don't want to react as an investor. That's a really bad place to be. So prepare for the next bear market in advance when your mind is rational. Don't react. Read the Wall Street Journal a few days late and know that the next bear market and major correction is your golden opportunity to outperform everybody else. So with that, I will conclude my remarks and turn it back over to Sunil and try to stop sharing this presentation. I might need somebody to direct me, stop share. Okay.
I think that was really wonderful, Lauren. It was simple, but very, very, insightful. And I'm very sure it was great learning for everyone. A few questions. Obviously, it is very easy to decide to do a lot of things, which look simple, but very difficult to implement it, particularly in a world which is not normally rational. And, as managers of public money, you have to manage the near-term expectations also. And you had a wonderful slide which showed, that almost every average individual investor underperforms the S&P 500. But as a portfolio manager, how do you, address the near-term concerns of your investors in case, obviously, ultimately you will turn out right, but in the near term, markets can be irrational for a longer period of time. Any advice there of how you tackle that?
With my investors?
Yes.
I mean, I'll say that we do most of the work with our investors on the front end. At my old office, I had a huge sign above my door that just said trouble is opportunity. It didn't even say the name of the business. And if somebody came into my office and they said, I don't really get that. And I thought, we're not a good match. Now, of course, we're dealing with accredited investors, qualified purchasers. These are very seasoned investors, and our minimum is quite high. But so we do some good work on the front end to make sure they're going to be good partners to us. It's very distracting to have somebody invested in your partnership that doesn't buy into the strategy and it's going to be short-term or myopic in their thinking and withdraw capital at the worst time, because that just creates an administrative distraction for you. So we tend to do a ton of work on the front end. Of course, we send them books on value investing all the time. We're constantly talking about trouble as opportunity. We say things like, hey, you're probably going to get a call from us in a big market sell-off, and we're going to ask for more capital. And there are going to be times when you want to give me capital where I'm also not going to take it because I don't find any opportunities. And I think just having that conversation over and over again will lend itself to creating very good long-term partnerships. We certainly have clients that see the world the same way we do, that will call up all on their own and say, do I need to invest today? The market has sold off. What type of opportunities are you seeing? So I'll say we do most of that work on the front end.
I think you, in your presentation, you did mention that, you all don't sell a position unless something else can give you 50% higher returns. Somewhere you also mentioned that the best time to buy is when, obviously things are completely looking very, very bad. Does that mean that, a little bit confused, whether you all take cash calls at all? Because, on the one hand, we are saying that we will not sell till there is an opportunity which is at least 50% higher than what we have already in the portfolio. On the other hand, we are waiting for some kind of a bad news to really, really pump up our investments.
Yeah, it depends. So that was Sir John's discipline, right? When to sell. He thought about it and came up with that 50% rule. And it's something that we certainly think about and calculate. And we're thinking about that mostly, in a bear market, can we switch to something that has higher upside if we're out of cash? We do right now, we have a 5% cash position. Like a lot of value managers, cash is organic in our portfolio. I would say we are never targeting a certain cash position. Usually cash tends to build as the market gets pricier, because what is happening is some of those tactical discounts are closing. Companies are close to their intrinsic value, and we'll take money off the table at that point and start looking for other opportunities. But in a pricey market, instead of taking a week to find a new investment, it may take 2 months to find a new investment. It just gets harder, and the whole process slows down and becomes quite sluggish. There have been times in my career where I've seen as much as a 30% cash position in our portfolio. Again, that's completely organic. I never sat down and said, I want a 30% cash in position. We would always like to be 100% invested, have so many opportunities that we would like to be 100% invested. And again, it just depends. Is the investment a tactical discount that we're playing, or is it a compounder? Is it a long-term investment in our portfolio, a quality company, maybe one with a high free cash flow yield that we're focused on? It just depends on the type of investment in the portfolio.
Right. And you did mention about 700 companies in the US having price to sales of more than 20. I had my analyst also dig out the details, and a participant has also mentioned that there are 374 companies. My analyst says there are 361 companies in India which are more than 20 times price to sales. But we are in this world where obviously there is a lot of thematic investments which are happening. In India, for example, anything to do with EV and renewable just shoots up. There is no I would say, sanity in terms of price earnings, price to sales, and so on and so forth. But how do you marry that with, say, commodities, which tend to be quite low P, and obviously they tend to be very volatile? So would you advise investing in commodities?
It depends on what commodity. I think some commodities have.
It is a way of investments altogether.
I'm sorry, we have a bit of a bad connection. Can you hear me?
Yes, I can.
Okay. So it depends on what commodities. Some commodities have rebounded really nicely off the lows. I'm thinking specifically about copper, etc. But again, it depends on the commodity. We'll invest in a cyclical business at the bottom of the cycle, So I think there are some commodities that are still quite cheap and that are priced below the cost of production. That's when you want to buy a commodity in a cyclical business, not after a big run up. So, we will occasionally invest in a company like that. I can remember a few years ago, I was presenting at a conference in Omaha, and I pitched the stock ArcelorMittal, and this was a room full of institutional investors, and people were rolling their eyes. I've actually never had this experience before because I was really kind of shook by it. People were rolling their eyes and shaking their head and like, what is this girl saying? What is this? She's so dumb. And it turned out to be one of our best investments ever. So I left the stage, and I was telling my husband, I was like, oh gosh, that was so embarrassing. That did not go over well. There wasn't a single person in the room that thought that my thesis was credible. And he said, Lauren, it's probably going to be the best investment we've ever made. Nobody thinks it's a good investment. So that's just a a little background on our history there. I've got a great new podcast out, or I think it's great. Sorry, you may think it's awful. But I started a podcast this month called Zinvesting. And I'm trying to interview some of the smartest investors in the world on a weekly basis and put out these interviews. I've got some really interesting ones, but the first one was with Jim Rogers, and he thinks commodities are the investment going forward. Of course, he's always says that, and he is, the founder of the Rogers Commodity Index. But he really likes commodities, and it's an interesting interview if you want to listen to it. It's on zinvestingpodcast.com.
I think you did mention that to outperform, you have to do things differently, and your call on ArcelorMittal was exactly, walking the talk as far as doing things differently was concerned. Lauren, you did mention that you used the opportunity of sort of a lot of concerns on India's ability to vaccinate its population, and you were able to invest in India. What's your view on India right now? And particularly given the fact that India has outperformed China quite significantly, how would you, sort of compare the two countries in terms of equity investing at this point of time?
Okay, so I am very positive on India. I think, again, it's a bifurcated market. There are pricey securities in India. You do need to be careful what you buy. You need to be selective. It always matters what you pay for an asset. But let me tell you why I like India over the long term. I think India combines many really attractive macroeconomic factors, including a low per capita income, a young population, and a heavier presence of higher margin asset-light firms in the technology sector. So when you're talking about comparing India and China, and we can mention the regulatory issues in a moment, but just looking at the two different countries. So India's per capita income is $6,390 US, compared with China's at 17,200 USD. So what we know from studying history is that when countries experience economic growth from a really low base, the creation of wealth among its citizens is transformative to the economy. And this is very analogous to China's economy 20 years ago. You can turn to demographics, which is the second thing I love about India. And India is probably the best well-positioned country in the world in terms of demographics. So Japan, Europe, US, and even China are all advancing in age, which may slow economic growth over time. So to give you specifics, India's median age is 28.4 versus 38.1 years in the US, 38.4 years in China, 42.5 years in Europe, and 48.4 years in Japan. And then lastly, India's technology sector is already well developed and represents 7.7% of GDP compared with 5.5% of GDP in the US. And we believe that technology will continue to be a source of economic growth and productivity in the years to come. And the country already has just such a great foundation in this sector. So over the long term, I really like India as a place to invest. Now, of course, we're bottoms-up investors. We're not macro investors. So we're going to be looking for individual opportunities in stocks to take advantage of. But I do like India over the long term. I think it has a lot of positives. I think you have to be careful what you pay for an asset, whether that's in India or the US. These are precarious times. You need to do your homework. I would avoid the companies trading at price to sales ratios 20 times, 10 times. I mean, sometimes we've seen some really even higher ones, right?
Yeah.
And I think we're starting to see the market revalue assets, right?
Right.
As interest rates go up. some of these growth companies are going to be penalized for that.
So exactly, exactly. I was running up. We're running out of time. So very quick answer. What's your view on the interest rate scenario and how it's going to impact the way you invest? Very quickly.
Yeah, well, it's favorable to us because we're value investors. So as interest rates go up, people move in on the risk spectrum. They will not take as much risk and invest in high growth firms, gamble on growth. I think those companies will be penalized. And this is all favorable to value investors, particularly with inflation in play. I mean, you really don't have a good investment scenario outside of investing in value stocks and quality companies. So,
and one last question, there's this whole talk about decarbonization and companies having to adapt procedures which might increase their cost in whatever they do. How do you build that in your investment decision, because it's going to become mainframe in the next 4-5 years, right?
Yeah. I would just say carefully. I mean, there's been so much money that has flooded into ESG strategies. It's something that we think about. But then conversely, you can look at ESG as an opportunity. One of the most interesting investment strategies that I've heard recently came from a really famous investor I was meeting with in London. And he was managing a strategy where he would go into emerging markets and pick businesses that had really low ESG rankings. And they were coming in as activist investors. They would get a seat on the board, and then they would push through these changes that would affect the ESG rating. And of course, as the ESG rating would go up, more institutional money would come into the stock, and it was an opportunity for him. And I thought that was a really interesting way to play this. So, one of the most interesting strategies I've heard in a while.
Lauren, this was really, really interesting, very insightful. I thank you on behalf of all the participants and on behalf of CFA Society India for taking time off and speaking to us. We hope to have more interaction with you with your permission in future. Thanks a lot.
Thank you so much for having me. Thank you, Sunil.